I always think I'm fairly gloomy, but there's nothing like when I talk here in BMG. Usually Paul sets it up, so I come across as quite bullish by the time I start talking. So, and yes, I did start very, very young, short trousers. Technology is not my strong point, so let's hope. Well, if you couldn't manage it, I'm sure I won't. But there we go. Where am I pointing this? Oh, there we go. Happened. We seem to have missed one already. There we go. Very good. Just a little bit of background. Yes, I have been involved in fund management since 1986, so that's all I do. It is not involved in anything other than fund management. There's a team of 3 of us on the desk, and a lot of experience between us. James is the junior. He's only got 12 years experience, but Nick's sort of approaching my sort of age, so we go back a long way. Our style is macro driven and very fundamental driven as well. So we were just discussing technicals briefly just now, but I'm afraid my eyes glaze over after a couple of charts. So we are much more fundamental in terms of how we look at things, and we are very global. In terms of running money, I think the most important thing is to set your stall of what you're trying to do and have a clear objective of what you're trying to achieve over the long term. As far as I'm concerned, that's what we do, and I'm really not interested in benchmarks. They don't help me, and they don't help a lot of people run money, and people are forced to track indices and benchmarks, which is great. I'm happy to leave them to do that. But as far as we're concerned, we need to meet our long-term objectives for clients in terms of making money. Now, let's see if we can be gentle with this. Yep. Oh no, it's 2 at a time. There we go. So it's 2 forward, 1 back by the looks of it. So just setting out our stall. Overview, we've still got high unemployment around the world, certainly in the mature economies. Yes, we've seen unemployment come down a little in US in particular, and UK to some extent. If you look behind the statistics, it doesn't paint quite such a rosy scenario. Despite the fact that the US population is on the rise, the labour force has been surprisingly shrinking over the last number of years, and quite quickly in percentage terms really over the last 5. In other words, if the labour force that was there in 2009 was still there today, unemployment would be over 10%. But we've seen that participation rate shrink. People are taking themselves out. Black economy? I don't know. Are they all just retiring early because they can't find jobs? I'm not sure. Interest rates. I don't think any of us could have believed 4 years ago, early 2009, when interest rates came down very sharply, we would still have a 0 interest rate policy around the world, and certainly with the amount of money printing that's gone on subsequently, that interest rates could still be falling. Interest rates have still been coming down. It was only a few weeks ago when the ECB cut, and various other countries followed: Australia, India, Korea, and others. So interest rates are still coming down, and inflation. Again, if we went back a few years, I mean, I remember being on panels and discussions back in 2010 about really the general consensus is: are we just going to get high inflation or hyperinflation from quantitative easing? And this is QE1 days, and now we've just got unending QE, printing of money around the world, and where is the inflation? I don't know. I mean, I began to think the back end of last year, beginning of this year, inflation must start to creep through with this continuous unending money printing. But we're still seeing inflation numbers fall, and that's pretty much everywhere. Subpar growth. There's hardly been a GDP number announced any time over the last 12, 18 months that has actually been ahead of expectations. Everything seems to be at the lower end of the range or even outside it. I think the latest one was India this morning, or was it over the weekend? I'm not sure, but again, very disappointing growth figures. You know, this is for an emerging economy that was supposed to be running with China a couple of years ago, and year on year it's now on 5% in growth. And that may sound like a nice number, but for an economy like that, at very, very low levels and very low wages, that is a disaster. That's a stalled economy. And it's the same in all the BRICS. Well, China, as already been discussed, you know, I think expectations have been lowered, and I think we'll struggle to see. You know, I think 6 to 8% is probably where we're at for the next few years. And corporate earnings. Yeah, I mean, first quarter US earnings were up year on year, 4 to 5%, depending on whose numbers you look at. That's not bad. That's not bad, but the equity market's risen 20-25% on the back of that, so you're paying an awful lot more for those same companies than you were a year ago. And across Europe, UK, revenues are declining, earnings are flat to negative, and yet equity markets have risen quite strongly. So you're just, it's multiple expansion. You've got to be happy to pay more for those companies you want to invest in. That would be okay, and certainly we wouldn't say the PEs are particularly high by historic standards. I mean, they're high-ish, but normally high PEs are associated with strong growth or growth to come, and I don't see where there is any growth out there in the near term. In fact, from a European perspective, you know, I suspect they're going to be in recession or bumping along the bottom for quite a number of years, not quite a number of quarters, I do mean years. So that's the happy bit. Just Eurozone unemployment. In fact, this is already out of date. This is a couple of months old. Yeah, Eurozone unemployment is 12.1%. and probably still on the climb. That's a big number for what is a pretty mature economy. But the pale blue charts, I know they're not very clear on there, but that is the youth unemployment, in other words, under 25s. Staggeringly awful at around 24% across the whole of the Eurozone. Don't forget that includes Northern Europe, Germany, etc., as well as the 50% plus youth unemployment in Greece and Spain. Horrendous, and austerity is not helping that. And inflation. Yeah, these are some inflation numbers which are reasonably up to date. Over the last 18 months, you know, 2010 and first half of 2011, when there were fears about where would inflation go, and that was something to do with what happened in the third quarter of 2011 when markets fell off pretty drastically. There were real fears as to what would happen next, but this seems to have disappeared out of conversation. But 18 months ago, inflation in the US was 3.9. It's now 1.1, and showing no signs of any particular uptick. I don't know how much lower than that it can go. China, we've seen, again, we're not sure on the numbers, but there was certainly a bit of a surprise recently. I think it was with the February number when it came down quite sharply and has since stayed there. Eurozone, which lagged on inflation, and it seemed to be stuck around 2.5%, and then has fallen quite drastically down to 1.2 very, very quickly. And even UK, where we have a history of high inflation, with the expectations that were raised by Mervyn King last autumn, actually hasn't met those. He's got most of the inflation forecasts wrong on the upside and appears to be on the downside now. But I think UK inflation, with a bit of a blip up this summer, will also start to fall. So no signs of any inflation, despite this unending trillions of banknotes being printed. I won't dwell too much on this, but we have got still a lot of headwinds. I've given up talking about the Eurozone for quite some time now, because I still don't know where it's going to go. I didn't know where it was going to go 4 years ago, except that I didn't want to be there. We've held no or negligible euro-denominated assets since first quarter 2009, and have no intention of changing that anytime soon. It is a flawed concept, and nobody shows any sign of wanting to change that. Of course, the whole of Europe politically stands still until the September elections are out the way in Germany, and then we might find out what happens next, but there's probably more of the same. Japan, Abenomics, well, he certainly made a bit more of a success this time around than his brief period in office 5 years ago, which was a bit of a disaster. Will it be a success? Well, he's got off to a good start on a monetary and fiscal basis, and achieved quite a lot in a short period of time without having to do very much. But the critical point will come in the second half of this year, after the upper house elections, which one assumes he's going to get a decent majority for. There doesn't seem to be as much political infighting at the moment, whilst he is being successful, so it'll give him perhaps a short period of time to actually put together some strategic and structural changes. If he doesn't, I suspect we'll be slipping back to where we have been over the last good number of years. And China, a change of direction is really about, are the new leaders going to be able to enact what they've talked about, which is focusing away from infrastructure projects and more on the domestic economy. And again, it's going to be watch this space. They've certainly got off to a reasonable start in what they've been saying, but we will see how that leads through. In the US, very little in the way of decisions is being made because of the political stalemate, and nothing's going to change until we get the midterms, and that's still another 18 months away. So it just means that an awful lot of decisions aren't being made, and Middle East and Syria is constantly swept to the sides, or even not even reported on these days. But it is worrying in terms of where that is going, as more and more factions seem to get involved locally. Going back to the Chinese domestic spending thing, this is a chart that just shows that we're showing Hong Kong, Korea in terms of private consumption as a percentage of GDP, and you would expect that that should be a more normal area that China will be aiming for. It's not that consumption's been tailing off so much, but with very, very high GDP growth, it's been very difficult for consumption to keep up with that when the focus has been on infrastructure spending. But I suspect over the next 10 years we will start to see a steady and slow tick up in that, which will be healthy in the long term, of course, for global growth, but in the short term the focus is going to be away from infrastructure and commodities, and maybe not so good, because demand for the rest of the world's goods is likely to continue to weaken. Oh, got the double act. Let me get it back. Yeah, fiscal and monetary. I mean, debt to GDP around the world is generally high and generally still rising, particularly amongst the mature economies. Banks' balance sheets have improved over the last few years, but Europe still refuses to tackle its banking problems, and showing no signs of changing or having any aspirations to do so. It's little by little. I think the European politicians and the ECB are just hoping that world growth will bail them out eventually. Otherwise, it's going to be an awful long, hard road. Budget deficits, well, we keep getting these questions, is it the right way? Well, it clearly isn't the right way, but I think we've probably gone too far down the austerity route in Europe, and it's really just destroying economies in the Eurozone, particularly the southern Eurozone. And yes, I'm sure there'll be a little bit of a move, but I think things have already gone too far. Effectively, most of southern Europe, in fact an awful lot of Europe, does not need the single currency, but I'm not sure when anybody's going to come, any of the European politicians are going to come to that conclusion. And yeah, we've still got zero interest rate policy and quantitative easing, and they're creating an asset price boom, but none of that money appears to be finding its way into the real economy. It's just creating asset price bubbles around the world, and meanwhile real earnings growth is generally on the decline. People are take-home pays are shrinking. You know, in the US, real earnings at the median level are back where they were in 1994, so hardly progress in terms of expecting consumer spending to bail out growth. And these are just a few debt to GDP numbers. You know, they're not that relevant, I guess, in terms of Japan, UK and US. You know, as long as the money printing continues, it really doesn't matter. But for these economies, I mean, Greece is never ever going to pay back its debt. We might as well accept that. And the Italians' debt is just growing probably to an uncontrollable number. And that's the same in other economies as well. This chart is a bit complicated. Sorry, I don't want to spend too much time on it. It's an IMF data chart. This goes back to the late 1920s, talking about a boom. The colours aren't very clear, but that is financials, in other words, banking sector credit. And it is about debt to GDP, debt to nominal GDP in the US. And you can see what happened back in there. The banks were allowed to go bust, and the debt was written off. You can see households had quite a lot of debt, and a lot of people again went bust. Corporates were the worst offenders, and again a lot of corporates were allowed to go bust. And governments, of course, had to take on a lot of that debt. So from having a fairly low debt base in the 20s with a high tax take, very, very quickly government debt accumulated, and the war years, of course, accumulated. Governments had very, very high debt. But it did mean post-World War II in the 50s and 60s and 70s, the economy was allowed to come out of that deep depression and recession and start to rebuild itself, and probably doing it quite nicely. As you can see, tax revenues obviously picking up and government debt receded. But then from about 1980s or mid-80s onwards, we've suddenly seen debt massively pick up again, and particularly with the banking sector and the household sectors, less so with corporate. And now we're in that same position again, where governments over the next decade will probably be taking on more and more debt, as at some point with normalised interest rates, which may be several years away, a lot of this debt will collapse into financial failure, I guess. We're not making much progress. We've made a little bit of progress in the last couple of years, but this is only up to the end of 2011, and I think we're actually back in another bit of a credit boom at the moment being created by central banks and governments. So I'm not sure we're going to see that come off very much. We could easily have another peak, or certainly a flattening out there, before inevitably, for the world to show some kinds of growth, the global economy to really go forward, debt needs to be written off, and we need to start from much, much lower levels. Hugely too much debt as a percentage of growth around the world. Now, this may not be relevant to here particularly, but I think it's just an indication. It's the easiest M4 numbers we could get. M4 is cash and credit in the system, and this is related to the UK. What we're saying here is that over these last 30 years, there's been a reasonable growth through most of those periods of cash and credit in the system. Financial crash, Bank of England, money printing, 375 billion in notes have been printed and thrown at the UK economy. And none of that, until very recently, until literally into 2012, has found its way into the real economy. Where has that cash gone? It has not found its way anywhere towards spending. We've now seen a bit of a tick up back to zero, so we've not got negative money growth and cash, but it's not that inspiring. That'll need to move much, much higher to get any kind of inflation or growth going again. So it's going to be quite interesting to see how that number feeds through over the next 6 months. There are some opportunities out there. Things we have liked, although I must admit we're finding it very, very difficult to find opportunities, particularly in risk assets that we like. We've certainly been, Japanese equities have been our largest weighting for a number of years. We've focused very much on how we've geographically allocated the portfolio, in other words, tried to make currency gains, I think, from being in the right places. We do like Southeast Asia and have been participating, but on the other hand, I do feel that the market has risen pretty sharply, and I think there's a double risk in the region, not just from equities falling back, but also from currencies getting hit as well. We've seen a lot of hot money find its way into the region. Where we've held equity outside of Japan, we've generally held large cap equity with yield. We want some kind of return on our capital investment, but that's the same as many others. And we have liked prime property, but I've got to say, with this very sharp rise in property prices over the last 6 months, we've started to take some profits there. So there are no risk assets that we are piling into at the moment. We're just being very patient. Let's see if I can get the next one. And I think it's probably a final chart on currencies. Asset allocation, or global asset allocation, is quite interesting, and it doesn't really matter whether you use sterling or the dollar. We've got sterling in this chart. We have got a dollar one as well. That's over the last 5 years. That's you're taking sterling as a flat line, and two extreme examples really. That's the Singapore dollar against sterling, and that's the Korean won. Now, we've had quite a decent weighting to the Singapore dollar since around about there in the portfolio, and we've been very happy to do that, because we've made some very nice money just holding cash on deposit in the Singapore dollar without having to take any asset price risk as well, and that's been a good return. And it's an example of where we made a lot of money in 2008 out of being in yen and Swiss francs when the carry trade broke up. So what are we? Let's just summarise what I said at the start, and the fund itself, special situations. Just a couple of charts very quickly. That does suggest we've got rather a lot in equity there, but I have to point out that most of the alternative strategies are equity protection, particularly against the UK, particularly against the FTSE and indeed the S&P as well. We've only got about a net 21–22% in equities, and that is very much biased towards Asia and Japan, and very little else. We've got a lot of managed cash, and a lot of that is dollar denominated and Asian dollar denominated. Very little in resources, only 1% in gold. We were big holders of gold through most of the last decade, but we took our profits much too early. actually at slightly even lower levels than we are today. I am watching gold closely, and I think there may be an opportunity in the next 3 to 6 months to maybe look at going back into there. Property weighting has been on the decline as we've taken profits, and our fixed interest weighting is mainly Asia and Asia short-dated investment grade debt, and mainly sovereign, nothing very high risk at all, and actually we've got some market neutral debt there as well, so very, very low risk. And got two again. And geographically, you can see that the weighting is probably, you know, I call Asia Asian dollar because a lot of it is quasi-dollar anyway, and the currencies that we hold. So we've got about 50% dollar related. We've still got quite a decent amount of yen, but a lot less than we've held in the past. And a core weighting in sterling as a sterling core asset anyway. Just a few charts on historic performance. You can see that the fund has been very boring since the financial crisis back in 2008. We took risk off the table pretty quickly, and we've got. There's two sides to this. The pale blue line is the MSCI World Equity Index. I have no ambitions to beat that index, but it at least serves as what's going on around the world. But you know, we've missed a lot of upsides. I mean, we've had reasonable upside when markets have risen sharply there and there and there, but with no way have we followed those index returns. But on the other hand, we've missed the downsides as well. So we've been pretty low volatility and rather too cautious. We've missed rather too many opportunities. But the problem has been is that the opportunities have been driven by central banks and politicians. They've not been driven by economic fundamentals. That makes it quite hard because you're taking your views and chances on what a central banker may stand up and say. And there's a couple more charts. There's a 10-year one, I think. Can't see it from here, but I think that's 10 years. So you know, just to say that we did have rather a good 2003, 4, 5 actually. This fund does take on risk when it feels it's appropriate, and when it feels that the risk we're taking on the upside is greater than the potential downside, which is not what we feel at the moment. And that's since launch. In fact, it's not since launch. Phil discovered, I think, yesterday that we haven't had a chance to change it, that actually that's a year out. It's missing the first year, so it actually would look slightly better than that if you included 1998 in there. And I think that's pretty much it. Right, well, for those of you like low volatility, all this is showing is that the further over you are to the left, the less risk, the less volatility the fund is, and the higher is return. So, you know, this is compared with funds in its deemed sector or similar style profiled funds. It's been a pretty low risk fund. And that's pretty much it. So hopefully that wasn't too upbeat for you, and I hope there's some good questions out of that in terms of thoughts, ideas, whether they be local or global. Are we taking the questions here or there, up on there? I don't mind. Are you going to participate, or is it just me? Don't mind. Are you? Well, perhaps I'll. Don't know. These probably don't work. Let's go over here. Must be.